the Congressional Budget Office, the CBO, announced this week that the federal deficit is now $1.6 trillion. That's lower than its forecasted $2 trillion. I guess that's good news. But they also see the deficit increasing by over 60% in the next 10 years. And that's if nothing else is added to it, which of course is a fairy tale. Just to be clear, we're talking about the deficit, not total government debt. The deficit is the amount we're spending each year that exceeds tax revenues. The deficit is currently 116% of our nation's gross domestic product, the highest it's ever been. How does the government fund the deficit? Well, they borrow it. They do that by selling government bonds, many of which end up in your investment portfolios, your 401ks. In 2024, the Treasury will not only need to borrow the $1.6 trillion deficit, but the Federal Reserve is also working to reduce its balance sheet, which ballooned during COVID. In all, the government needs to sell about $2.7 trillion in government bonds this year. That's less than 2023, but it's still an amount of debt that can never be repaid, according to the CBO. So what's that got to do with mortgage rates? Well, once funded, most mortgages are packaged up as bonds and sold on the secondary market right alongside all that government debt. Considered a safe investment, mortgage bonds compete with Treasury securities in a bond market that's already crowded with other corporate and municipal bond issuances. Bonds are sold at auction. High demand will raise the price, which effectively lowers the yield on that bond or the interest rate. Lower demand will reduce the price, effectively raising the yield. Too much supply causes the latter, which pushes rates higher. That's something we've experienced all too well over the past several years. What will increase demand and lower those rates? Lower inflation. That's why we're so focused on it. Next week, we get the Consumer Price Index, CPI, for January. This is an important indicator of inflation. It's forecast to be at 0.2% for the month. If it's lower than that, demand for bonds will increase and mortgage rates will fall. If it's higher, just the opposite. Fingers crossed. For the week, mortgage rates ended a little bit higher. Here are the national averages. Conventional, 30-year fixed rate, 6.97%. That's up 0.34 from a week ago. 15-year fixed rates, 6.33%. That's up 0.38% from a week ago. 30-year fixed rate, FHA and VA, 6.23%. That's up 0.23 from a week ago. And 30-year fixed rate jumbo, 7.31. That's up 0.19% from a week ago. Moving on, investors, save the date. If you own rental property in Washington State, save your dates for this important event. The Rental Housing Association of Washington, that's rhawa.org, is holding their annual spring workshop and trade show on Saturday, March 23rd, 8 a.m. to 4 p.m. at the beautiful Cedar Brook Lodge in SeaTac, Washington. This is your best opportunity to get important information for your rental business from across the industry in a single day. You'll hear from housing providers, property managers, attorneys, financial experts, including myself, and more, to build up your knowledge base and run your rental properties with confidence. Lunch and snacks will be provided along with a beer and wine reception after event. The space is limited. The last time I checked, there were about 90 spaces remaining. So be sure to register soon and I'll post the link at the bottom. That's all I've got for this week. Be sure to reach out if I can help answer any of your financial related story problems. You can call me 206-915-3742. You can email me, eric@ericismybanker.com, or look for me on social media. Look for Eric is my banker, and be sure to subscribe to my YouTube channel so you get my weekly updates plus lots of other cool stuff as well. That's what I've got for this week. I hope you have a great weekend. Talk to you next week.